Currency pairs explained. The FX market is traded in and priced in pairs. And the reason for this is really very simple. To buy money, you need money, but obviously you are not going to use the same currency to buy and sell. You would not buy 10,000 US dollars with US dollars. That would be a little silly. But you may need to buy 10,000 US dollars with your Australian dollar. The current Australian dollar US dollar rate is 0.77822. So in this case, to buy 10,000 US dollar, it would cost you $12,849.84 Australian dollars. So you would be exchanging your Australian dollars for US dollars, or selling your Australian dollars and buying US dollars. When you are trading in the FX market, you are doing exactly the same thing. You are simultaneously selling one currency and buying another. Each currency pair has its own three-letter abbreviation. The United States dollar is US dollar, the euro is EUR. To understand how these pairs work, let's take a closer look at the EUR-USD pair, which has a current exchange rate of 1.18771. When looking at a quote for any pair, they're referred to like this: base currency, quote currency. The base currency is always 1. So how much of the quote currency is it going to cost me to buy one of the base currency? In this case, it will cost me 1.18771 or $1.19 rounded US dollars to buy 1 euro. Long trade. So if you were to go long, the euro US dollar, you would be exchanging your US dollar for euro. You would be simultaneously buying euro and selling US dollar, and you would want the price, exchange rate, to go up to make a profit. Short trade. If you were to sell, go short, the euro US dollar, you would be exchanging your euro for US dollar. You would simultaneously be selling euro and buying US dollar, and you would want the price, exchange rate, to go down to make a profit. Note, the pairs are always quoted around the same way. Buying the euro US dollar would be exactly the same as selling the US dollar euro, but thankfully, to save an immense amount of confusion, they do not do this. The pairs are always quoted the same way. With most financial markets these days, you can go long, buy first and then sell later. Just as easy as you can go short, sell first and then buy back later. And because the FX spot market is just a ratio between two currencies, there is zero bias between long and short. You can see why people refer to opening a position and then closing the position, instead of just saying that you are buying and then selling. The lingo can get confusing when dealing with short trades, and especially when dealing with complex derivatives. If the rate was going up, that would mean that the euro was increasing in value compared to the US dollar. So when you were looking at a chart, it is really the base currency's value that you were thinking about. If the chart price is going up, the base currency is strengthening relative to the quote currency. If the chart price is going down, the base currency is weakening relative to the quote currency. The chart always reflects the strength of the base currency compared to the quote currency. When we're looking at the euro-US dollar rate example, there are 4 possible things that could influence this rate. 1. More people buying euro than there are buying US dollar, euro demand, chart price going up. 2. More people buying US dollar than there are buying euro, US dollar, demand, chart price going down. 3. More people selling euro than there are selling US dollar, euro weakness, chart price going down. 4. More people selling US dollar than there are selling euro, US dollar weakness, chart price going up. So the euro-US dollar rate could be moving around a lot, but it may actually have nothing to do with the euro. It is just that demand is significantly increasing for the US dollar, so all rates that are paired with the US dollar will most likely be moving. Or if the demand for euro is strong, but also the demand for US dollar is equally strong, the rate may not change at all. The majors. Like we said earlier, there are about 180 different currencies around the world. but many of these have very low liquidity, unlike the US dollar that is classed as the world's reserve currency and is traded significantly more than any other currency. You can see in the chart below, over 75% of the daily trading volume comes from the top 4 currencies. The most traded currency pairs in the world are called the majors. Euro US dollar, generally called the euro. US dollar Japanese yen, generally called the yen. British pound US dollar, generally called the pound, or cable or sterling. US dollar Swiss franc, generally called the Swissy or franc. Then you have the minors, still all paired with the US dollar. Australian dollar US dollar, generally called the Aussie. US dollar Canadian dollar, generally called the loonie. New Zealand dollar US dollar, generally called the Kiwi. Next we have the exotics, least traded but still crossed with the dollar. US dollar Chinese yuan, generally called the yuan. US dollar Mexican peso, generally called the peso. US dollar Singapore dollar, US dollar Polish zloty. Then we have the crosses, pairs not involving the US dollar. Australian dollar Canadian dollar, Australian dollar Swiss franc, Australian dollar Japanese yen, Australian dollar New Zealand dollar, Canadian dollar Swiss franc, Canadian dollar Japanese yen, Swiss franc Japanese yen, New Zealand dollar Canadian dollar, New Zealand dollar Swiss franc, New Zealand dollar Japanese yen, Euro Australian dollar, Euro Canadian dollar, Euro Swiss franc, Euro British pound, Euro Japanese yen, Euro New Zealand dollar, Euro Mexican peso, Euro Chinese yuan, British pound Australian dollar, British pound Canadian dollar, British pound Swiss franc, British pound Japanese yen, British pound New Zealand dollar. So the 3 main things to remember are 1. Base currency, quote currency. 2. Base currency always equals 1. Quote currency is telling you how much of the quote currency it will take to buy one of the base currency. 3. If the chart is moving, it is the base, first currency you are thinking about. If the chart is going up, the base, first currency is increasing relative to the quote currency. If the chart is going down, the base, first currency is decreasing relative to the quote currency.